And Tom, are you ready? Yeah, Tom's very excited. Pass you over. Hello, Philip. Philip's Friston's in the room too. Philip's a VSA expert, so we're in good company. Tom.
Yeah, hi everybody. Tom Williams here. Thank you for tuning in. Lovely to talk to you. And as everybody knows, I'm talking to you from a little resort town on the south coast of England called Worthing. It's about 40 miles south of London. The nights are pulling in. It's getting dark now, and it's certainly getting chillier, which is quite normal. Anyway, can they all see my chart? Right. Now, this is the daily chart of the S&P 500 futures market, the mini. Okay, so I always like to look at the daily chart first. Just to trigger me off. It gives me some idea of the general direction. It's almost like a signpost. And don't forget, a chart is a language, and it's talking to you, and all you've got to do is to learn it. It's like if you're having trouble with your eyes and they say you've got to learn Braille. It might seem a little bit daunting at first, but gradually, as you keep plugging away at it, you suddenly realize that you can read the chart. Now, we've drawn two new trend lines, as you can see here, showing the general downtrend. Now, of course, currently we are oversold. And when you drop below these lower trend lines, there's a certain amount of vulnerability where you might get a pop-up, a rally of some sort. Not a rally, but an up move. And of course, don't forget, this lower trend line will act as a resistance line. If it's going to move up and go up to the top trend line, there'd be some effort to push up through that lower trend line. So it's worth keeping an eye on that. Now, last weekend's newsletter, right, I predicted that the market looked weak. Even though it was on the lower, it was oversold. And why? Well, come Monday, look, that's Monday. That blue bar, look, that means it's an up bar. But, of course, look at that volume. There's no demand. There's no demand where you're not going to get an up move with no demand stuck in the middle like that on a Monday. And not only is it low volume, look, as you can see, colored pink by the computer, because we're looking at relative volume relative to the two previous volumes, it's low. Not only that, looks a narrow spread, up bar. And that confirms it. And but anyway, why do we say the market was weak last weekend? Because you've got weakness here. Whenever you see these wide spreads down like this, as it pushes down through the body, shall we say, of the market here, look, as it rushes towards and down through that, it's normally a sign of weakness. Now, you've got to be careful if you're not too experienced with it, because the volume is very high, look. And you might say, oh, it's stopping volume. It's not stopping volume, because to see stopping volume, the market has to be vulnerable. In other words, you have to have a move down. If you saw stopping volume here somewhere, that might be a different story. But here, it's not stopping volume, although it's down on high volume. It's a sign of weakness. That's pressure on the market. Don't forget, stopping volume will only occur after you've seen a down move. The market becomes vulnerable to one or more professional groups saying, right, I think we can make something here, and they'll move into the market. But before they can do that, they've got to put all what we call weak holders under pressure. And of course, in all these markets, when they move sideways like that, there'd be hundreds of thousands that are long, right? Now the widespread down through that as they push down on high volume is a very good way to lock a lot of these potential weak holders in these markets, right? And that means then that all those, a weak holder is a trader that if he sold right now would be losing. And the way the herd or the mentality, whatever you want to call it, human beings don't like losing money. So they look at it and say, oh, well, God, I think I'll wait. But you should never wait. Always close the losing trade out fast, because you can see the way the markets work, they're not designed to let you out of your problem. That's how it works. And so that there was part of the influence to say, here on no demand, the market's weak, because you've got these weak, this week here is definitely weak, and then these bars here don't look all that strong. Well, they're not, they're weak bars, and I think I mentioned that at the time. And why do we say they're weak bars? Because, for example, this one looks got a top tail to it, right? So in other words, from the close of the previous bar, they've marked it up, and probably in there's either supply or no demand, and then that makes it weak, and that's why it's come off like this. But that's clearly last Monday, no demand, very clear. There's even a signal there. Yeah, well, there are. Computers agree with me. No demand. Don't forget these signals were put in there years and years ago, and they have not changed. I've had no access to a programmer on this one, so they're still the same, and they will be the same in years to come, because this is how the markets work. You're not going to get higher prices. The professional side of the market saw very well that there was weakness in the background. That's definitely weakness. We saw something like that even yesterday or the day before on the 10-minute S&P as it pushes down through this body here on high volume. But the main thing as far as you're concerned, if you happen to be long, bite the bullet and get out, because they will not help you to get out of your position. And you can see that by this red trending system, how it's so persistent, right? Red, red, red all the time. Ignore the level bars. If you get one blue bar, if it like goes up, closes in the middle, or you get no demand, that's weakness. And so we plummeted. Here's another sign of weakness here, look. Widespread down as it pushed down through that support line. Right, so right now I've seen nothing to warrant going long on this at all. So that's the daily chart of the mini S&P future. Now, I'll look at other charts in a minute, but is there any questions on this one?
Yes.
Rita shouts out, yes, because she's looking at the screen.
From Edmund. Wednesdays and Thursdays volume is similar, but the spread on Thursday is much narrower. Is this the reason for today's possible up move? Also, Mark says, does Tom see any strength on Thursday's bar with the high volume and narrow spread? So two very similar questions about yesterday's bar there, Tom. Thursday, so it's Monday. Yeah, so the volume is quite high and it's a very narrow spread, and they're wondering, is it possible we'll have an up move today? And is it strength? Yeah, here you are.
Yes, you will get a certain amount of demand coming in at times, and that's what we're looking at. And the signpost for that is, as you observed, it's first of all, it's got to be a down bar. Secondly, the spread has to be narrow. Thirdly, the low is usually in the fresh low ground. In other words, not absolute fresh, but there's nothing to the left you can see on the chart. And of course, if it closed in the middle. So this is natural. And that's why it's gone up today, Friday, look. Not a lot, but it's gone up. And that's the reason. Markets work without question on supply and demand. And we can, you don't have to be too clever. Don't ask too many questions. Don't read anything into it. As I say, Peter here said, oh, they've gone to lunch. Well, it's rather funny, really, but it's not going to make any difference, believe me. The markets are so huge, the momentum is so great that lunch will know, and they don't go to lunch anyway. They may go to lunch, but they take all their mobile computers or whatever they use with them, believe me. But no, you're quite right. That's a sign. But it's not a great sign, is it? Because a great sign would be much, much higher volume than that if it was stopping volume. And it would probably be a clearer down day. In other words, the whole of the body would be below the close of the previous bar. And then once you see that, you know that some professional groups have stepped in thinking they can take that up. Not a huge bull move, perhaps, because you have to build a decent cause for a decent bull move, and we haven't seen that yet. But you will get rallies, of course. And you can see that we're oversold, so we're vulnerable to one or more groups thinking they can take this up a little bit. Now, of course, if the price hits that other side of the trend line, that will be resistance, and it will take an effort to push up through that. And usually they might suddenly gap up or something like that on news.
Stephen, has any idea why on a Trade Guider Futures plugin I have not got a no demand signal like we have on I've never seen or used the plugins, and I couldn't answer that. Pete, can anyone else here answer that question? Pete or Tom?
Yeah, hi there. Yeah, so we don't know the answer to that question. It's worth contacting Trade Guider, their support, just to point that out and ask that very question. It may be something they can resolve. Philip Friston saying perhaps a different data feed. What data feed do you actually have on that plugin, Stephen? So, for example, we've got, of course, the Trade Guider program with real-time data.
That isn't. That's
oh, sorry, no, is it?
This here is the.
Oh, I beg your pardon, it's eSignal.
Sierra.
So, I mean, there are differences between the data providers from time to time. But if you're concerned, you know, if it's maybe you've spotted a few things, it's always worth feeding back directly using their support system. So I'm sorry, we can't answer that particular question.
Yes, when you see a principle like no demand, or one should be there, that's why it's a good idea to check different time frames. So I think I showed you last week. We showed you why last, at one time we were talking about last Monday, I can't remember what it was, but it was clear on the NASDAQ and that what was going on, and yet not quite so clear on the S&P 500. But it's all there, it's built in, because this is how the market works. Without question, markets move on supply and demand. And when demand comes in, it has to be on a down bar. You'll see the spread narrow. It usually closes in the middle. And you've got to be vulnerable. In other words, you've got to have a down move behind you. You can't expect professional money to move into the market if there's no weak holders all locked in there. That's how they make their money. They've got to shake these people out and absorb their selling. And we can see that going on with the sudden high volume, narrow spreads. Now, if you don't see that, you may see variations of the same thing, but a much smaller scale. And it will give you, like it was pointed out yesterday, was a very small scale buying opportunity. And that's why it's popped up a little bit today.
Okay, on that subject of that of Stephen's question, Thomas says, I've had that sometimes, and you may have to close the chart and reopen it again. Stephen says, I should know to read the bars. Well, fair enough, yeah. I mean, I come across things. The other day, there was in the 10-minute, I saw a no demand, and but the program didn't pick it up, and so of course I started questioning myself. But it was a no demand. So your eyes are better, or your brain, right? Okay, this was the first question that appeared on the screen, so I'm going to read this question, Tom, from Alan. Could Tom take us through his process of taking a trade by, for example, looking at the daily chart of the S&P futures and then look at if he sees anything that is of interest, then follow through on the 1-hour chart and see if there are any principles in line with the higher trend. Finally, a lower 15-minute or 5-minute to see if any principles give us a possible entry. This would enable all to learn to read what Tom looks for and sees before actually taking a trade. The idea of this exercise would be helpful no matter what instrument one is interested in, as it will help ingrain in us a solid process we can follow. So basically, take us through what you'd be looking out for to take a trade.
Well, the thing is, once you can read these charts, when something pops up, you recognize it. I mean, if you're a cat and you want to catch a mouse, you probably have to sit up on the fence for hours on end looking quietly and waiting for a mouse to walk by. And then when you see it, you recognize it immediately, you jumps on it. But sure, I know what you mean. We'll look at another time frame in a minute. But the daily chart is usually a nice way of getting some idea where the market is. And it's like a signpost, really. But if you want to trade, now Rita just spoke to you, and she made a successful trade, and the husband, Peter, separately, because they sit in different rooms. They're almost like competing with each other, which is great. You know, that's wonderful. That's competition. Rita, do you want to describe what you did or not? Just wait. On the Dow, wasn't it? All Rita does, and Peter, they wait to see. That's one of my story about you've got to wait for your bus to arrive. If you're at a bus station and you want to get home, you know pretty well the number bus that you need. And Americans may not be too familiar with it because they all go by car everywhere, but if you happen to live in Europe, you'll find a lot of Europeans have to go on the bus. And when your bus pulls in the bus station, you recognize it. And you pop on board and you know that the bus is going to take you in the right direction. Getting the wrong bus. Now Rita's looking to see. Can you see it, Rita?
How do I get that volume? Yeah, I've got my volume. Just so people can see the volume as well. Well, the volume is the...
Peter says, "You want to say?" Rita's trying to show you the chart yesterday where she made a trade. Is that it?
Yeah.
Right.
made several trades this week, and it's been a wonderful week, mainly because we're actually in a bear market, which is always easier. So for just an example of what I do, simply put, obviously look at the daily chart first for some idea about whether the market is strong or weak. Then I would go down to a 1 hour chart to look for signs of weakness or strength, high volume on up bars or high volume on down bars, depending what's been happening. Always avoiding the market open, and I'll tell you about that little mistake I made this week, and that's part of my trading plan, is to keep away from the market open, because that's when all the volume is created. It's very volatile, and I'm not prepared to set my stops so far away and risk so much. So it's too volatile at the market open. So wait for the market open to sort of settle down a bit and the volatility to go along, and then look at what the volume was created. And this was yesterday, and as I've said before, all I'm interested in is at the moment getting 20 points profit, and I don't go any lower than a 10 or 15 minute chart in order to do that, because I can't rely upon getting that kind of movement in a 5 minute or less. And here we are at here's our volume that came up, very high volume after the market open. The next bar went up, but well, quite frankly, it didn't seem to want to go very far. There's quite a bit of effort there, but it didn't want to go very far, and I thought, well, here's might be a sign that there's some weakness. And of course that weakness was confirmed because the next bar was a nice bar down. So if there'd been any buying on there, this bar here would not have been down. So the next bar, B, is where I took my short, and that is what we call a no demand. Obviously, there's gone up and back into this area where this high volume was on low volume. So there's no interest in going any further. So I made quite a nice successful trade there as it came down. I got out because it started going up, but then there's an increase in volume as well here, which obviously made that go up. But then at point C, I got in again because it went up, but on low volume, so it's no demand. But there was no signal there. And of course took my 20 pips very, very quickly and happily down there. At which point, because I had to go out for some reason, I went running. Sorry, I go running about 7 miles each time, and I find I'm running on hyper energy after trading. But anyway, I went out running and I came home, and look, there was another lovely opportunity which I'd missed, of course, by D, our lovely up thrust there, increase in volume, back up here again, and in fact there's a no demand there as well, so I missed that one, but that would have been a lovely one as well. So basically that's what I do. Is that all right, Tom?
Yeah.
Do you want to say anything, or shall I read the next question? Is 14:30? Yes, Thomas. Sorry, we're in the UK, and 2:30 is your open for us. How long would you wait, Stephen? What does that mean? How long would I? Oh, what, for after the market? Well, actually, sometimes I've seen after 10 minutes a very nice principle appear in the 10-minute, straight after, sort of 2:40, but not always. So yeah, it would be half an hour to an hour, but it's got to be clear, always clear, and it must be obviously a VSA principle. I always ask myself, is this a VSA principle? And if the answer is yes, then that confirms it. But the other thing I was going to say, part of my rule is, of course, to avoid the market open, which I didn't do one day because I'd seen weakness, saw the market was weak, sort of an up thrust, thought I'd go short. What they did was they took the market up a bit and took my stop out and then followed down. I made it back because not long after I saw confirmation of the weakness. But it's a typical thing. We are our own worst enemy. We know you can work out how what works for you, but do we always stick to it? No, because I don't know, we get sucked into it, and you just find yourself learning the same lesson over and over again. How do you set your stop? I generally keep my stop at 20 or 25 points away on the Dow, this is. But I'm very, very careful to avoid getting it wrong, basically. Okay, so I'm just clicking off this and getting rid of, okay. What have you got there? What about the, right, the 5-minute ES? Mark would, all right, okay, Tom's got this chart he wants to talk about, hang on.
Well, it doesn't matter what chart you look at, tell you a story. Now, the chart up now is a 10-minute chart of the mini S&P, and right here, apparently, Peter's told me it's 1:30 UK time, eh? 10 past 1. Now, that's a good hour before the market opens in America. Now, this is a 10-minute. Right, so we got the first signs of weakness here. Look, widespread up. Look, and it tells you, the computer told you, there's supply coming in. So that warns you. Widespreads up like that. Now, of course, that's Globex at the bottom there, so it's never quite so clear because it tends to obviously clash when the big S&P pit opens up. But the spread there, and the computers recognize something. Let's come up with a signal, and that's supplies that are coming in. Right, supply is coming in. Please read these dialog boxes. Somebody told me, oh, they don't bother to read the dialog boxes. Now, Philip Friston re-edited these, and he's done a fantastic job on these. And as I told you, we don't hold any secrets back. Right, everything we know, we tell you. We don't have any secrets. We don't have any crafty formulas. We don't have anything. All we're doing is reading the chart, which you will be able to do. And once you master it, there's very few people in the world, and I mean the world, can do this. Now, why that is, I'm not quite sure, but there you are. Anyway, so we got the first sign of weakness there. Market is 10-minute, remember? Now, that black bar there is definitely a sign of weakness. It's colored black because it's level. And the reason why we're influenced in saying that's level, because of this in the background, look. We've got several signs of weakness right behind us, look. And that's probably going up on no demand. No demand, look. Now, it's running live, so that's why something flicks like that. But a black bar means it's a level bar, no demand. And there's another one here, another signal. Weakness has appeared. Thank you, computer. Right? It's not, doesn't include your emotions. It's just doing what you told it to do. Don't forget, these signals were programmed 10, 12 years ago. And they work now, and they'll work in another 10 years and 20 years' time. And then once you learn to read the chart, right, which you can do, then your skills as a trader kicks in, and you will never look back, I can assure you. It's probably another hurdle, I suppose. I say your skills as a trader's got to kick in, because you've got to overcome your own emotions. You've got to overcome the things that don't come natural to you. as Rita was saying. So it's all these little hurdles. But once you do that, you're a professional trader. Right? Okay, so you've got all this weakness here. And then the red bars start kicking in, look. And this is why you have to close out. If you're the wrong side of the market's not there to help you. And you can see that, look, down, 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 down. This is done deliberately. It's not by accident. It's done deliberately to put pressure on what we call weak holders, people that are locked in these higher prices or fail to do what was necessary here because they can't read the chart. Okay, so the market for the 10-minute chart. Okay, now we look here, and of course there was some sort of stopping volume appeared. And there's even signals here, look. Quite a few of them. Potential stopping volume. Yeah. Shakeout, all sorts of things here, haven't we? Shakeout. Okay, so there was some spread that came in there. You can see that with the high volume. So the market arched up over, right? And that's usually arches up on no demand. It doesn't mean to say it's weak because you've got this strength in the background. It just means professional money want to make sure that everybody's been shaken out as much as possible before any potential up move. Right? So down, down. They want to put pressure on anybody that's in there. The market falls back down into this level, look, here, where we saw all the high volume coming in. Look, there it is. It pushed down through that, and the volume relative to this volume is low. That means that the pressure on the downside of the market has been removed. The professional money are not interested in pushing that market down. And that shows you with the low volume relative to this here, look. There was supply here in this area. It arched up. That's really a form of a test, right? But that's a clear principle. Your bus has arrived. So you jump on board and you right, and up you go here. Now this bit here, look, a widespread up with a heavy increase in volume, right? It may be supply, but it may be what we call pushing up through supply to the left, right? In these highs here, back here, there have been probably thousands of traders locked in, and they weren't shaken out here, right? So they're still in there. Professional money know that. They know statistically that there'll be people locked in there. So they don't want them to sell because they don't want to have to absorb or buy their selling. They want to buy down here. They don't want to buy up here. So they widespread up, close on the high is a good way to stop people selling, because then people say, oh, look, 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 I'm out of trouble. I'm out of trouble. I'm making some money now. And that's it. And they stay in. Right, so that is pushing up through supply to the left. Now, if that is true, then you expect the market to be tested. And there is a down bar there, look. It's not really what I call a nice test, so I don't like these tests with top tails. But it is a red down bar, and the volume is relatively low to this here. So that means that it's okay to go up a little bit. And there we are. It's gone up here. It seems to be going up on no demand. It seems to be arching over. That's a 10-minute chart, but they're all readable, all these different time frames. Any questions there?
Edmund asks,
Rita's.
This is the 1400 bar.
Yeah.
A lovely shorting opportunity.
Oh, yes.
Yeah.
Oh, yes. Well, the reason it's a short is because it looks pretty much like a bit of an upthrust. The volume's low, is it?
Yes.
Sorry, I can't see it very well.
Volume is low on that 1400. Yes.
Yeah. Now, the reason why you go short is because of the weakness in the background, look, which we've spotted here, loads of it. And the no demand up bar shows you that the professional money are not interested in higher prices at that moment. And they can't mark the market up, the floor traders or the market makers. Don't forget, they're hooked up with the cash market, but the cash market will be doing the same thing. It will not go in a different direction to the future because of arbitrage traders. They ensure they both run together, and they've got a mathematical formula that ensures that. But we can't do it because you have to trade thousands of contracts to make any money out of it. But as I said, it's like an auction room. You go to an auction, right, and say there's an item there, $100, right? That's what you reckon it's worth. Okay, but he starts off $200, any 200, he looks around, and right, if there are no takers, that's no demand. Because the audience sitting there know this thing's not worth 200. They know it's only worth $100, and therefore they refrain. And they're not exactly stupid. They're not going to go in and bid for something they know is overpriced. And then the auctioneer is forced back down to a price where people start bidding. And that's no demand. The same thing happens in the market. You see it time after time. And you see it, of course, when you've got weakness in the background. It's this background information. And that allows the professionals to mark it up, knowing full well that they don't have to worry. The market's weak. They're probably short anyway. But you see that time after time.
We're still on this chart. Yes, Mark, we will get to the 5 minutes in a minute, but well, don't move yet, Tom. There's a question on this one, and go back to where you were. From Jack, as it arches over at 130, so, you know, it's arching over, right? Yeah. Volume falls as it's going up and increases as it's coming down. Also, you mentioned weakness in the background. How do you know that spring will succeed when so many others fail? Oh, he says, I think I meant 1600. Sorry, hang on. Now it's making sense. Oh, yeah. How do you know that will... or whatever.
Funny, if you call that a spring, that's not my terminology, but that was, I think it was SMI, Bob Evans used to call it a spring. It is a spring, but I call it a shakeout just before the up move. I never liked these fancy names because it might confuse people. But why do you know it's going to go up? Because, very, very obvious, you believe the principles that the market works on supply and demand. To the left, you can see high volume, right? So you know there's a lot of supply in the market, right? And then suddenly, on that shakeout, or spring, whatever you want to call it, the volume is low. So that's a high volume, and that's lower. So you know the market works on supply and demand. So the market goes down even a little bit lower than the original demand that came in, and the volume is low. That means that the supply that was over at the initial point has disappeared or greatly reduced. That's all they want to know, and they'll dive in. And because that's how we know. You've got to believe the principle. You know that's your bus. That bus has got your number on it. And if you learn that principle, right, you will start reading these markets, which are not all that difficult, especially all these different time frames. You know, it's marvelous, really. You've got all these different time frames. If something's not clear on one chart, look at the others. So all sorts of things pop up.
We are going to put up the 5-minute because Mark would like you to talk about the principles that may be appearing or have appeared on this. Is that right, Pete? I don't know. Oh.
5 minutes. Right, so this is a 5-minute chart. Okay, so we have a look at it. Right, there's the stopping volume for 5 minutes. Right, loads of signals all over the place. Test. There's something there, look.
Potential stopping.
Potential volume, yeah, potential stopping volume. We call it potential because nothing's absolutely certain in the market, as you know, but it's certainly potential. But your skill as a trader will recognize it because your mind is much, much better than a computer. All a computer's doing is telling you what principles to look for. So you type, your programmers type in the parameters that bring up a principle, right? So what does your bus look like when it arrives, right? Is it double-decker, is it single, what you know, what color is it, and so on. That's all the computer's doing. And these signals were created many, many years ago, and they will be around for many, many years. And even if people say, well, what happens if the market changes? Doesn't matter with VSA, with this, because as the market changes, the volume below or activity will change and the price spreads will change, but the principles will always be the same because you'll always have a professional side of the market there prepared to jump in. And when we talk about professional money or smart money, we're talking about traders that can throw in 5,000-6,000 contracts, and that will alter the balance of supply and demand because other traders see that and they follow as well, right? And if it's enough, it'll alter. You'll see it on these charts. So it's 5 minutes, so there you are. Now, what we want is confirmation. Okay, so it goes up, looks how it's arching over. There's even some no demand here. That's fine, look, because we expect it to be tested. And lo and behold, sorry, there's a test. And there it plummets down, look, bang. What's happened?
You've gone to a different chart. Hang on.
Oh, sorry, I've got this radio control keyboard. And you could easily press the button wrong, sorry.
You're there now.
That's, I'm here now. I'm trying to get the cursor to move. That's better. Okay, so there we are. Lo and behold, our bus has arrived. Right. Now we know it's running live, so that's why it's shooting forward like this. We use live charts. We don't use all this hindsight stuff. But there we are.
Potential stopping volume.
Right. Well, yes.
Yeah.
What, Peter?
I'm saying if you compare it to over here, of course.
Yes.
Illustrating your point.
Yeah, exactly. What we're doing, illustrating my point, that volume there, look, is considerably less than these volumes around here. And this is a 5-minute chart. And when you see that, you know you're going to get higher prices because the supply, it dipped down into fresh, low ground. In other words, not much to the left on your chart. Okay, there's the volume. it's low compared to the previous volume, and that's why it's gone up, look, because the markets move on supply and demand. And it's a language, a chart's a language talking to you. It's actually talking out to you. And once you get your head around this, you'll be one of the relatively few people in the world that can do this. Now, why that is, I don't know idea. Okay, so this is 5 minutes. So it looks like a bit of arching over, look. There's probably no demand there, is there? So there's no demand there, look. So that means that there must have been a bit of supply here somewhere. Up here, look. After an up move has taken place, you're vulnerable. And this arching over like a mushroom top is always a sure sign that somebody's selling. Because every time it goes up, tries to go up, you get a slightly lower top. And then, confirmation, look. Now that's clear, look. See that low volume right there, look. The computer's colored it pink. The computer's telling you, look, this is low volume. An automatic response to that. And that's a shorting opportunity course. And then, once you do that, these black bars are level bars. But the market's devious, it's cunning, it wants to trap you, it wants to get you. That's why you get these up moves like this and down like this. It's all designed to do you in. And to be quite honest. But that's how it works. But get your head around it all, and you will be able to read these charts, and you'll be able to sit back and smile. And you'll get so good at it that you can more or less predict the market almost continuously. Now I do a newsletter, and last week's newsletter, I think we said the market was weak. Did we? Yes. Yes. Rita says yes. Rita types it all out. She's a very good typist. She can type almost as fast as you can talk. And while she's typing, she can be looking around the ceiling. I don't know how on earth they do it, but they are. So she has a skill I certainly don't have. But it's very interesting.
Okay, Pete has been waiting very patiently. Could we look at Microsoft daily and weekly charts? And thank you, Edmund, for your comment about the newsletter. Thank you. Thank you for the newsletter. It is very, very good. They were just putting up. And Jamie, you're asking for today's action in gold. We don't have the data for what's going on. We only have daily charts. If you want us to look at daily chart, just let me know in the questions box. So, is that daily or weekly, Peter? This is Microsoft daily, and then we need to look at the weekly. Yeah. There you go.
Right, so this is Microsoft. Don't forget you trade in harmony with the parent index. So if the parent index is showing weakness, then you expect this stock to come off with weakness. Don't matter with Microsoft or what on earth it is, because stocks follow, well, they make up the index, and that's what you're looking at here. And this is probably one of the reasons why. Is this a daily chart? Right. Okay, why the indexes look weak. Look at that. That's an upthrust in anybody's language. I'm not sure it's up to date, Tom. Let's check. Yeah, go on. No, it's not up to date. I'll just do a quick... we're just updating the... We're just updating the daily chart. Sorry about that. I normally do this. That's it. It is now. So it's up to date now, look. It's only one bar missing, but you've got an up thrust, look. Right, and I'm sure the index was weak at that point. Is that no demand?
Yes.
You've got an up bar, look, here. No demand. That means that the floor specialist controlling this stock, right, is marking it up, and there's no professional interest. It's been marked up again, look. A black bar shows you its level. So they marked it up, probably try to catch as many stops as possible, mislead as many traders as possible, only to close the middle after you've seen no demand. That's weakness, definitely. And then it starts to fall. Black bar here.
It's up. It's
No demand.
volume. Yeah.
So there's a blue bar, look, right? It's been marked up, almost collapsed on the low, and look at that low volume. That's no demand. And then they mark it down, even gaps down here, look. Probably on some bad news. There's a little bit of stopping volume there, look. That's fine. But it hasn't responded much. The volume's low. But there's not enough calls there for that to say it's going to become bullish. And this gap down is not a good, healthy sign. It's not healthy. And don't forget, the general index appears to be weak, not all that strong. But saying that, there's no pressure at the moment as we're looking at this, and it could quite easily have a little rally of some sort. But you've got weakness there. And look at these no demands. That's always a sure sign that once you see a stock declining, especially from these, what looks like an up thrust, up bar, no demand here, right, and you get these no demand up bars, that's a sure sign of weakness. Okay?
I'm just putting the weekly up because he asked if you could look at that.
Right, we want to look at the weekly, right?
That's today, that blue, that. This week. Oh, this week.
This week, yeah, this is a weekly chart. Now, look at why has it gone down? Well, there must be weakness at the top here. Is that no signal there? No. Right, so there must be weakness there. But whenever you see, I mean, really not much enthusiasm there for the upside, is there, look? At all. And don't forget, you've got an up move behind you. So the market is vulnerable. They may be craftily distributing. That could craftily be a distribution area. And then look how these red bars, they've done deliberately. Ignore the level bars. Down, down, down. They're locking in weak holders. Right. Little bit of demand came in. It popped up, look. No demand. Look at the no demand. And the widespread down is normally, that's a sign of weakness. That's not stopping volume. These widespreads down as it pushes down through a former area of support. Look, I'll draw a line through there if I can. Oh, anyway, that level there, look. When you see these widespreads down, closing low, and a slight increase in volume, not excessive and not low, that's a sign of weakness. So you would not be wanting to be long or go long on this stock at the moment. But it will get strong with the index in time.
All right, well, we've got a question here from Gordon. Does Tom have any thoughts on GAN retracements?
Well, yes, we use the 50% retracement quite often. It's very useful. I think it is. No, I'm not. I never use anything like GAN or Dow theory, any of that. I call that a load of rubbish, to be quite honest, as far as I'm concerned. Markets move as we're describing on supply and demand. You don't need all these other fancy things. These other fancy things like GAN and that have been built up by people that can't read the market, and they're trying to create some sort of business out of it, probably. If you ever get told anything in the market that they have a secret or they know something nobody else knows, you must immediately recognize it. You're being groomed for a con of some sort. And so keep well away from that. Learn to read the chart on the supply and demand principle, and you've got all these different time frames, and it can be done. I mean, you read my newsletters, and most of them are correct. Occasionally you slip up, naturally, because the market's devious, it's cunning. And have I got all the information? Sometimes they hold back volume and all sorts of things. So, but despite all that, generally speaking, you can read these markets. But if anybody out there tells you they've got a secret and they want you to come to their seminar to hear it, then you know definitely you're being groomed for a con of some sort. Because there are no secrets in the stock market, because there are too many clever people out there. And if there was anything, they'd spot it very, very quickly. Not only spot it, they've got big money to back it up. That's why we never use, or I never use, mathematical formulas. Because look, if there was an obvious mathematical formula that was going to make you money, then you wouldn't think that those people out there, real clever ones, backed with money, don't know that as well. They would, as soon as it started to appear, they would be in there trading, and the fact is that with trading would dilute the formula, so it wouldn't be there anyway. And I think myself that when you look back and test these things in hindsight, they may look good in hindsight, and that's because they weren't traded enough. Professional money certainly wasn't trading there. And so keep that in mind. Now, on saying that, you see, in as far as we're concerned, occasionally, once you see an up move and you see weakness coming, sometimes you have what we appear, or appears look like a test, right? It may be a nice looking test, which we've seen recently, all right? Now, if that test was genuine at that moment, right, then professional money would dive in. If they don't, in other words, if the next bar is down, that's a built-in sign of weakness. Something's happened, and they're not interested. Professional money, that's what we're looking for. The money that will change the balance of supply and demand. And we can see it taking place.
Okay, perfect timing. Time's up, and that was our last question. Oh, hang on. All right. We have one last question from Colin. Peter, you might be helpful. Has there been any progress on being able to upload the recordings of these sessions to the VSA Club, Peter?
Yes and no. Yes, I've managed to upload some videos. No, they're not displaying yet. I've got to do some more work to get those to show up. So all I can say is I will have a go probably tomorrow, I think, because it might take me a while to get my head around it. So it's slightly tricky sometimes to put these things up. They used to work quite well, but it's a several-step process, and I have still got the charts, and I have actually physically uploaded them to the server, but they're not displaying. So thank you for reminding me.
Okay, Tom, do you want to say last words?
Right, it doesn't sound good last words, does it? Do you want to say last words? Well, what I say is thank you very, very much for listening. We always love and enjoy talking to you. And just a 1 hour session doesn't sort of bore you. It doesn't sort of heap information on you that you can't handle. So it's in small bites, and I think that's a good thing. But anyway, I say thank you very, very much for listening. And we'll be doing newsletter, what, tomorrow or Sunday?
Whatever you want to do. Tomorrow's fine with us.
Tomorrow, Saturday. Okay, so we'll be doing the newsletter, so you can look forward to looking at that. And if you look, it's well worth looking at that newsletter, because Rita types it out, and it gives you an idea how my mind is thinking. And then you might see If my mind's working that way, you may slowly train your own mind to think in that direction. Okay, so I'll say good night very much, and thank you very much for listening. Bye.
Well.